Okay. Hello, everyone. Welcome to another episode of my company health check series. For those of you who have not watched my previous series on American Express and Apple, do check them out. And of course, remember to subscribe if you like what you watched. Here, I will share occasional updates on my portfolio companies I invested in and am still currently holding. I will also analyze them using the bottom up approach, usually by looking at the quarterly reports all the way to the full year and beyond that. So I believe that by journaling my research in video format, I hope I can make myself more informed of my past decisions, whether right or wrong, and also share my insights with everyone here. Hopefully, all of us can benefit in some way, especially to my value investors like myself. So, why did I invest in Google? Okay, I will usually create a framework to screen good companies to target. All right. So when I look at companies, I will use the SWOT analysis. I believe some of you have heard of it. So I will dissect the SWOT analysis to different segments and counter them. So when I look at the strength, I will try to find reasons to counter it. And only if I can counter every individual segment, the strength, the weaknesses, opportunities, and threats, I will only choose these companies to further do research on. All right. So this takes a lot of time, and it's not done within one day. And I believe that you need to put in hard work to be able to at least generate a good return from the market, okay, as a value investor. So why Google? Okay, the strength is Google is one of the very few companies that have demonstrated strong, consistent net profit margins of above 20% since 2005. This is at least 18 years of strong earning power and have not been breached yet. Google has taken over the world of information and has been ingrained into our everyday lives. I believe that all of us have at least used one of their products at least daily, okay, whether you're young or old. A 2022 research report showed that Google's market share of the search business is currently at 47% worldwide. So for the weaknesses, okay, Google is a good target for various lawsuits. With the latest one on alleging theft on the data from millions of users, okay, to train its AI model. So this lawsuit has just started and is very uncertain what the outcome will be and what the material impact will be. So I will keep myself updated on this issue, and if let's say there is a outcome, I will also do up another post to talk about this case. All right. But anyway, the stronger the monopoly, the more it will attract attention from lawmakers and activists anyway. So while we cannot avoid lawsuits due to it being unpredictable, as a value investor, any business that provides a very strong defensive mode is able to last out its competitors. Of course, it must have a certain degree of certainty. So with those uncertain uh, situations, we will only need to look at how to minimize the risks by buying it below or close to the margin of safety price. So what are the opportunities for Google? I believe that Google's focus is currently on generative AI. So now it's created BART, okay, to compete with ChatGPT, and then Genesis for journalism, PMax for advertisers, and Google Product Studio for retailers. So by implementing all this, okay, into its AI, I believe that most of their products, okay, can add value to the users, and also eventually Google can monetize on them. So Google has long been experimenting with AI long before the media buzz. So there is still currently a lot of debate on whether generative AI will take over the world. I personally tried both BART and Microsoft Chat GPT. Okay, and but after using both these both of the products, right? I will give my feedback on it. Okay. So after using Bard and Microsoft ChatGPT, both of them appear to make mistakes in the information they provide. However, Bard seems less mechanical and more informative compared to ChatGPT. So let me show you what I mean on the next slide. So here, as an interesting example of me using Bard and ChatGPT to query my upcoming trip to Prague, I asked both the same question on the reviews of Bohemian restaurants in Prague. Notice that Google's Bard is able to show me pictures, and once you click into the pictures, it brings you to the Google review page and even gives you more information about the restaurant and a map as well of how to get there. So it will transfer you to the browser, okay, the Chrome browser, and it will show you how to get there. While ChatGPT's response is in full text format, and as you can see, it's not interactive at all because you cannot click on any button to bring you to the next page. You need to go to, you want to get more information about the restaurant, you need to do a separate search in a particular browser, in a browser. Okay, so this is what I mean by ChatGPT being very mechanical in its responses. So, with an upper hand currently, Google will implement its generative AI assets into all aspects of Google's existing products, as I mentioned earlier. Okay, and this is to enhance the user experience. Some of the product suites are set to be able to be monetized, hopefully at the earlier stage. Overall, I think that the key here is to look at its overall impact into the future of the internet as a whole. So, Google, with a formidable team of really smart talents, I believe that it can indeed leverage on its huge data bank and its current team to create useful, innovative products for the world to use going forward. It need not be the first to market, but most important, it's that it needs to learn and fail fast with the lowest cost possible. So the threats, okay, with Microsoft and many others jumping on the AI bandwagon, we will see very keen competition in this field as well. Microsoft is also has a formidable team, and with their recent purchase of OpenAI, who are the creators of the ChatGPT model, the learning curve for Microsoft is also on par with Google and could play catch up very quickly. So that is why Google also has put a red alert on Microsoft for the ChatGPT model. Okay, now let's look at Google's segmented revenue for Q2 2023. The largest share of revenue comes from Google Search alone at 57%. All other segments take around 10% of revenue share each. Most segments saw an improvement in revenue growth except Google Networks, and of course, this led to an overall growth rate for the 6 months ended at 4.6%. My conservative estimate is that this year, overall revenues will increase by 5% should the business environment remain optimistic for Google. Okay, on the segmental operating income front, we noted that there has been an outperformance in the Google Cloud business, which had incurred a loss in the same period last year and now has managed to turn into a profit. Because of this led to a strong net income growth in this current quarter of 11%. Overall, operating margins remain healthy at 29% in the current quarter. Okay, let's now take a look at the sales contribution based on the geographic locations of its customers. Revenues mainly came from the US and has largely remained so since 2022 at 47% for both 2022 and 2023. Then number 2 comes EMEA, or Europe, Middle East and African markets, of which its shares in revenue from those regions coming in at 30% for both 2022 and 2023. Lastly, it will be the Asia Pacific region that has generated 17% of its overall revenues. Okay, we look at the Q2 2023 total customer acquisition cost. We see an increase of 5% in total customer acquisition cost. And Google has categorized customer acquisition cost as cost of doing business, okay, or cost of sales. The good thing is that even though there's a slight increase in the customer acquisition cost for this quarter, we see that the proportion of total customer acquisition cost as a percentage of total revenue remains at 43% in both 2022 and 2023, thereby allowing Google to have room to play on its operating margins going forward. Okay, now let's take some time to look at the peers. Okay, we will look at Microsoft segmented business in the recent results. So you can get a better picture of both companies' relative performance. Even though both businesses use slightly different reporting standards and may operate in a different business environment, I think that we can use this information to paint a snapshot of the tech industry's business environment in the current quarter. We can then deduce a valuation relative to both companies. So Microsoft's productivity and business processes segments mainly consist of Microsoft Office, commercial subscriptions, Microsoft 365, LinkedIn Business Solutions, and Dynamics 365 Business Solutions, all of which employ the SaaS type of business model. And they have proven to be a highly profitable market for Microsoft due to its relevance and its value add in its own market. Okay, it's quite unique. That's why Microsoft have been proven profitable for quite a long time. While Google's reliance is on advertising and is slightly more cyclical in nature, thus the lower margins compared to Microsoft. But market have seemed to already attach this premium to Microsoft's share price, and based on its PE, it's currently trading at 30 times its forward PE ratios, 2023 forward PE ratios, while Google is currently trading at only 27 times its 2023 forward PE ratios, and this is in the worst case scenario situation. Therefore, as a value investor, I prefer to pay a reasonable price for a fairly good business rather than compete to buy a great company at a higher price, right? It does not matter of how the future will turn out for Microsoft and whether it may indeed outperform Google or not. But with a lower price paid for Google, I can be assured that my long-term returns will not lose out to my opportunity cost lost for not investing in Microsoft. Okay, now let's look at Google's management outlook for this year. CEO Sundar Pichai maintains focus and commitment in delivering superior products and services for Google's customers, especially in the field of AI. Efforts also include re-engineering its cost base and thereby creating improved capacity so that long-term results can remain sustainable. For example, by boosting efficiency involves cutting the time to generate AI snapshots into half. With faster responses times, teams can remain small and costs are also reduced. Okay, and service quality and ROI is also improved for advertisers using generative AI. And therefore, these AI goals can be met earlier and can be monetized quicker as well. So I have tracked Google's sales from 2005 to 2022. As you can see here, Google has shown resilience in its revenue growth and net profit margins since 2005. You can see here that net profit margins are mostly above the 20% range. And if you notice, such businesses are a rare find. If you can purchase such a business at a good price, you will definitely reap decent rewards if you hold on to the company for the long run. In fact, during both the global financial crisis in 2009 and the COVID crisis, Google managed to maintain its decent performance. This gives me confidence that Google's business may be resilient in times of a crisis. The possibilities of scale is also set to be bright for Google as they venture into generative AI across all their product offerings. Once AI has been optimized, I believe that Google can capture newer customers that aim to increase their own ROI in terms of commercial search and advertising. With cost efficiencies in place, I believe that Google's future profits will continue to grow organically and at sustainable rates. So now we look at this quarter's P&L for Google. Okay, year on year, its revenue growth have slowed, as you can see, from 13% and currently at 7%. Operating costs this quarter, were mainly offset by a reduction in its depreciation expense. The reduction in depreciation expense was due to the company's changes in its estimated useful life of its data center infrastructures, okay, which management had made them longer, okay, and therefore this explains the reduction in depreciation expense. So with management's focus on driving down costs, I believe that we will see net margins remain high going forward. So Google's net return on its assets remain above the 10% region since 2005 and up until 2022. This means that its assets, after deducting its debts paid on its assets, and it still managed to generate double-digit returns, which is very, very strong. And you can compare Google's ROA compared to its industry's gross ROA. The gross ROA of the industry is currently at 10%. So this shows that Google is set to outperform the industry in its returns on its assets this year, and also likely by a huge margin due to equity and debt reduction this year. So Google generated a free cash flow of $38 billion this quarter, or 28 times its current valuation. The free cash flow has improved compared to the same quarter last year, reflecting improved operating performance and also a deferral of tax payments to the fourth quarter, as mentioned by CFO. And there were, however, no mention of continued share buybacks this year. Okay, so we look at valuation. Google's current forward PE is at 27 times. Okay, its median PE is at 28 times, and the industry PE is at 39 times. So based on my PE forward valuation metric, Google's share price to me should be around $112 to $122 range. From what I can see here, based on the industry multiples, okay, the PE for the tech industry seem to be very bullish due to the recent quarters' very strong earnings from most big tech companies that have exceeded market's expectations. Okay, Google shares have seen hit another high after the promising 2Q result announcement. However, based on its peers in big tech, Google seems to be fairly valued at current prices. Should there be no more unexpected earnings surprises, and if results were to be in line this year, okay, I believe that Google will still be a good price to buy if there is any adjustments or corrections in its current share price. Based on the DCF, okay, discounted cash flow model, I value Google at around $538 billion, or 1.9 times its 2022 revenue. The current market cap of Google is priced at 1.68 trillion currently, okay, or 3.9 times its 2022 revenues. So in conclusion, after the reviewing the full results of 2023 businesses, I'm confident that Google will be able to comfortably meet its 2023 business targets. But whether it will outperform or not remains to be seen. Okay, my 5-year vision for Google still remains highly optimistic, especially in the field of generative AI, which has already been starting to reap early dividends, as Google is currently taking the lead. Therefore, at the price I paid for Google, makes me feel it's all worth the investment so far. Okay, so hopefully we will see better results in the next quarter's earnings. Okay, and if there's any surprises, I believe Google share price will be more than the current price. All right, so let's go for the win. Okay, and hope you guys make money, and do remember to subscribe. Have a good night and see you guys. Bye bye.